Splendid evening it is to you viewers. Welcome to Equity News right here on Equity Access, your cross-section of the stock markets and of developments in the Zimbabwean economy. I'm Ibn Mabunda. Let's get on to business. Our news tonight, the Zimbabwe Energy Council held a 2019 Outlook event in the capital, which was attended by captains of industry as well as key players in the energy sector. While speaking at the event, the Zimbabwe Electricity Transmission and Distribution Company, the ZETD's Corporate Services Manager, Engineer Richard Mariwa, made interesting remarks with regards to the operations of the corporation. Well, the ZETDC is a subsidiary of Zesa Holdings and is responsible for the transmission, distribution, as well as the retailing of electricity. Engineer Mariwa said that the monetary policy statement pronouncements have cast a shadow effect on the operations of the corporation, and says that the tariffs that they're currently running with are ridiculously sub-economic and could result in insolvency. Let's have a look.
Our tariff right now is not only sub-economic, but it's ridiculous. It's ridiculous. But tomorrow we can close shop and all close and go and walk home. Because it's you're talking of 3 cents, 4 US cents. It's not even enough to pay the hydro generating company.
Well, Zesa recorded losses of 200 and 400 million roughly for 2016 and 2017. Now, against that background, Engineer Richard Mariwa said that revenue for 2018 was $815 million, with $1 billion being owed to Zesa by its creditors. While Zesa Holdings, the holding company, has 5 subsidiaries, including the ZETDC, ZPC, which is the Zimbabwe Power Company, Zesa Enterprises, as well as Power Telecommunications and Internet Services Provider. According to Professor Mthuli Ncube, the Finance Minister, these 5 are set to be rebundled under one unit to improve efficiency within the corporation. Then, the Reserve Bank of Zimbabwe has released Economic Review Report for the month of December. Very much important. We're going to do a little bit of number crunching, but I'm going to try my best to make it as palatable as can. These are the deposits that we have in the banks. This is the money that's in the bank. Well, that of course is December 2018, but coming from December of 2012, you have $3.5 billion, 2015, $4.1 billion, 2017, $7.7 billion, then moving right up to $9.4 billion in December of 2018. Moving on to the deposits again, the Nostros, that's $400 million in 2009, 2014, 200 million, 2016, 200 million, then right up to December, that's $300 million. Talking about the RTGS deposits, again, you can see the graph right from $1.2 billion in 2009, and now we're sitting at $10 billion in December of 2018. Well, these are private sector debts. Okay, so these are the debts that the corporates actually have. What you're seeing, what seems to be the narrow yellow base there, is actually what the corporates owe to the central bank. But now they've reached what seems to be a limit of $200 million. Resultantly, they've actually moved on to the banks. So if we are just to perhaps backtrack and look at where we were in December, where we were sitting at about $3.7 billion in as far as the money that the corporates owe to the banks against $300 million central bank. June 2018, where we've got $3.89 billion. October, 3.98, slumping to 3.97 in November, then moving right up to $4 billion against, of course, that $200 million to the central bank. Then on to the Zim Forex reserves. If you can look at where we are coming from, we've literally had no Forex reserves coming from January, and it's been like that. Then in November, interesting development, we've got about 399 thousand US dollars. Then in December, slumping slightly to just about 393,000 in that sense. Why is this important? This is important in bringing stability. Now that we've introduced the RTGS dollars, what actually plays out here has a significant effect on how our local currency fares against other currencies. So it would be interesting to note how we've actually fared in January as well as February, as this is quite critical where our RTGS dollar standing is concerned. Right, then moving on to the government domestic debt. Our debt as of December 2016 was sitting at $6.41 billion. Well, this is just after the coming in of what has been called a new dispensation. This is the time where we are actually getting into elections, and our government debt is mounting to $7.8 billion. Then in October, we have the MPS as well as the release of the fiscus by the then new finance minister, Professor Mthuli Ncube, who's quite keen on reducing government expenditure and is promised now under a theme austerity for prosperity. But from the figures, it seems as though that government debt has actually been on an increase. If we'll check out October, that's $9.55 billion. November, that's $9.8 billion. And for December, that's $10 billion. Against what the minister has said that we're looking to reduce government expenditure. But for those 3 months, it has actually been on a scale. Well, the finance minister has been speaking about fiscal consolidation. But if you check the records, it seems not to be the case. And against this, the finance minister has several times spoken about fiscal consolidation. Let's have a listen.
We're managing to walk the talk. We're balancing the budget. We've recorded a fiscal surplus averaging $100 million a month for the last 4 months since we last met. So things are looking good. This is stabilizing the currency as well.
So there you have it. Now moving on to the money supply. Our money supply has scaled from $9.8 billion in November of 2018, and there's a 2% growth to $10.07 billion. Why is that important? Well, money supply has an inflationary effect. Let's look at the historic figures coming from December of 2013, where our money supply was $200 million. It grew over just 12 months to $4.4 billion. December of 2015, 4.8, 2016, $5.68 billion. This is when inflation is also starting to gain a bit of ground in Zimbabwe. December of 2017, $8.1 billion, right up to August, $9.8 billion. And now we are sitting at $10.07 billion. Now that certainly has an inflationary effect. So if at all we are going to be able to curb our levels of inflation, we have got to be successful at seeing to it that we keep our money supply very much contained. Well, moving on to the next story, ASX listed Invictus with all exploration rights in Zimbabwe released half-year results to 31 December 2019. Well, Invictus Energy is an oil and gas exploration company whose asset portfolio consists of what is known as the Kabora Bassa project, which is actually resident here in Zimbabwe, particularly in Muzarabani. The prospect, according to the results that they've just released, this is, of course, the Chief Executive Officer speaking about the explorations in Zimbabwe. According to one organization, NSAI, that did the explorations, they concluded that Muzarabani prospect contains a prospective resource of 3.9 trillion cubic standard feet of natural gas and 181 million barrels of oil condensate, totaling 850 million barrels of oil equivalent and gross mean unrisked in the primary target alone. Well, they're coming from a net loss position of 149,000 US dollars, and now their net loss position has grown 128% to 340,000 United States dollars. Well, this corporation has injected $3.5 million into its venture or endeavor here in Zimbabwe. But let's have a quick look at the breakdown of the figures in that sense. Well, they spent about $3.3 million in acquisition, or for them to, that's actually the initial cost of them engaging in the project here in Zimbabwe. Then 6% of their cost is $240,000, which is actually what they've put into the exploration. Now, earlier, the chief executive, Macmillan, who's the chief executive, Macmillan Scott, said that they were expecting to spend between $10 million to $20 million in drilling per well. Compare that to Sasol, which just across in Mozambique has spent $1.4 billion in its engagement as well as drilling for 13 wells. That translates to a figure of $107 million per well, against what Invictus is willing to spend $10 to $20 million per well. Well, to be also topical, it seems as though it's the season for Africa, and as far as all explorations are concerned, because just recently in South Africa, Total also made an exploration, and they discovered about 1 billion barrels of oil, which are said to actually going to last South Africa more than 10 years. Oh, it's time for Africa. Africa as a whole has actually seen an increase in the number of drilling oils, well, moving from a position of 77 wells in 2017, and now we're talking about 100. If things continue at this pace, who knows where we'll be at the end of 2019. Meanwhile, where Invictus is based currently is Australia's largest oil and gas event, and raised at that particular event right at the opening are concerns to do with carbon emissions. Making progress in a FinEx report, Delta is said to resume operations to full capacity as of next week. This comes following issues to do with foreign currency. Well, Delta requires about $7 million per month in imports in order for the corporation to remain in operation. So because of forex issues that scaled down their operations to 50% capacity, coming from a base of 90%, but now it says that they will now be able to move to full capacity in that sense. But as well, let's just have a quick look at their performance over the past few years. Their half-year performance in 2015, they recorded revenue of $290 million, as well as profit after tax of $43 million. 2017, PAT of $31 million, as well as revenue of $246 million, 0.6. Then half year of 2018, that's $32 million in profit after tax against revenue of $250 million, scaling right up to $341 million in 2019 against profit after tax of $57 million. But because of the disruptions that they've had in recent times, well, we might not exactly experience such growth. Remember that Dr. Mangunjika has predicted what seems to be a recession, so we might expect a decline where that figure is actually concerned. For a conversation on these and other issues, I'm joined in studio by our resident investment analyst, Respect Gwenzi. Respect, good evening and welcome to the show.
Thank you. My pleasure, Eben. Good evening, viewers.
Beautiful. Let's get the ball rolling. Respect. Interesting developments there, as well as revelations coming from the economic review by the Reserve Bank in that sense. Well, of note to me is the growth is in money supply, which I think is not such a positive development for Zimbabwe, as that is of an inflationary effect. What is your take where that is concerned?
Money supply has been growing, as you have correctly noted, over the past 1 year, but notably since 2014, we've recorded huge jumps in money supply, and this is against the background of increased government borrowings, both from the private, in fact, from the local private sector, in light of failure to access foreign financing. So, given the fiscal deficit position, which now sits at about 2.8 billion per annum as of 2018, coming from about 1.5 in 2017 and 2016. It has increased government's pressure, or governments resorting to private sector borrowings. So they've really been on a rampage to access monies from banks and like-minded and like institutions. But what that has aggregately done is to push money supply. We have now found ourselves with excess liquidity in the economy, and there's a chart here which shows money supply. There's a chart here which shows the overall deposits in the economy, which is a function of money supply. Because when money supply grows, it's like you give me credit, and when you pay back, you pay me back with interest, and that increases deposits.
Right.
So the level of deposits is always in line with the level of money supply. So when government borrowed, it actually led to a resultant growth in RTGS deposits. But at the same time, we have a real measure of the quantity of real money in the economy, which is USD nostrils. So our USD nostril positions was sitting at 0.3 billion,
which is a deficit of $9.7 billion, quite a while.
So as the gap widened over the years, it has resulted in an excessive pressure on the limited USD balances that are in the economy, and that has also pushed inflation, because we are demanding more forex from a growing RTGS balances, and that has obviously pushed inflation in the economy over the past few months, and in fact coming from mid of 2017 upwards.
Okay, you did allude to government debt and government expenditure in that sense. Well, we seem to be having a growth in terms of that debt, despite the fact that the finance minister is talking about fiscal consolidation, has put in a theme in the fiscus austerity for prosperity. What is happening there?
Yeah, government has resolved not to continue increasing the debt position, but the only way you can do that is by rebalancing your books. And we were made to believe that the central government is now in a position of matching revenues to costs. But then the sustained growth in borrowings shows that there's still been some excesses in terms of government's budgetary demand. So this has actually led to a growth in domestic debt. So government is still playing on the market in terms of treasury bills. I mean, pushing out treasury bills to the public and earning money through that to support its fiscal excesses. So that's what has been happening. So I think there's been insincerity on part of government to say we are not still borrowing from the open market, whereas data is clearly showing that they've been resorting to dipping on the open market.
But that's against the fact that the finance minister has said that there's been fiscal consolidation, and there's actually an excess of about 100
yeah, but
million.
those are 2019 figures. I think he was more referring to the January figures rather than the December. But from December, around December thereabout, he started to highlight that we are having a surplus driven by 2% tax money and so forth, and also inflation has had an impact of increasing government's revenues. So that growth, according to him, inspired a net trade surplus, a net fiscal surplus position, and he said that growth has been sustained into 2019. But what this graph is showing from the RBZ is that there has been a continued reliance on open market operations, issuance of treasury bills, in trying to secure more money for government to do its to support its functions.
Okay, then now that we've got a currency, the RTGS dollar, let's talk about the significance of that trend in with regards to growth in foreign currency reserves. We're seeing a growth from absolutely nothing, and then in November we've got just below $400,000 in forex, which slightly dips in December. A positive there, don't you think? Because we're coming from a zero base, and now we've got...
Yes, so this was mainly driven by the split in accounts between RTGS nostrils and USD nostrils. When government did that, they secured or ring-fenced the existing USD or any such kind of USDs. So what happened was money, USD money, that was habitated in foreign countries started to come in. So if a company had sold this stuff in USA, they would have kept their money in US accounts. Right. So when there was a clear separation of accounts between RTGS and USD, those money started to flow in back into Zimbabwe. So this is what led to this huge growth. So it's because government has created security and separated the two between the USD and the nostros.
Okay, so could this spell that perhaps this is what Professor Mtuli was referring to when he said, well, first of all, work at fiscal consolidation, addressing the fundamentals and making sure that we've got a little bit of stability, then introduce a currency? Is that
but a currency is already there. They've already introduced a currency.
I mean, since he came into power, because this is when he spoke about
yeah, but there has not been consolidation as yet. Of course, he said that in January he achieved a surplus position, but this is monetary policy driven. When you just separate accounts, there's no fiscus work in there. It's just about you splitting the accounts and saying, I've secured this. No one will tamper around the USD account. Rather, RTGS will remain as a local equivalent, but rather we also have a separate USD account. So this has nothing to do with fiscal consolidation. This is simply a splitting of accounts to say we are honoring USD obligations. If you put your money in the bank as USD, you get it as USD. But before that, there was just one account, which was an RTGS, which was a USD nostro, but in fact it was a combination of the two, and those could be equated one for one to the other. So now there's no longer that starting November, and that's why we are seeing that growth in reserves.
Okay, that's about at that scale, but perhaps moving down, or should I say cascading. Let's talk about the corporates here. Their private sector debt scaling from $3.97 billion in November to $4.4 to $4.04 billion in December. What is the story there?
The story here is, if you look at this figure, which is 4.04, you have to equate it to the aggregate deposits in the economy, because this is money that banks have loaned out to the public.
Okay.
Or to, public being corporates and individuals. So the amount is at 4 billion. But as a function of total deposits in the economy, that's just about 40% thereabout, from 42%. So if you look at a loan-to-deposit ratio of 42%, whereas the RBZ threshold is a 75%, in fact, 75% of your loans should be of your aggregate deposits should be loaned out to people who want to utilize the money, and that ratio is currently sitting here at 42%. So that shows that banks have not been lending out to the private sector despite this huge growth in deposits. Now I think the question is why. So we have seen two things happen in the banking sector. One, the average lending rates have been coming down. RBZ has pegged the lending rates at about 12% per annum. And now we have got an inflation. In fact, before the inflationary pressure, that rate was not adjusted for the risk of failure to repay. So bankers were finding value in expressing the money in TBs other than in expressing the money in loans. Loans at the risk of non-repayment, while TBs is government debt, which will always be paid in any way. But now we are moving into a totally new new field where you find a rate of 12% failing to beat the inflation rate, which sits at 56. So it no longer makes sense for banks to keep on lending at the current pegged rates. So banks will totally hold extending money as loans to the private sector at the moment. Treasury bills, they have a coupon rate of 5% per biannual, which means 10% in total, but without risk. Still, the interest is below the 56%. So banks are totally in a fix. They are likely to make money in the current environment only through non-interest income ways, just like your normal withdrawals from the bank and so forth. So this trend really informs us of the challenges that have been going on in the banking sector, coming from 3.69 to just 4.04. whereas the growth in deposits is coming from 7.7 billion to about 10 billion. I think that's the issue here with regards to loans and deposits in the sector.
Well, thank you for breaking that down for us. Thank you viewers for watching. Up next is Stock Markets with Anesu. Stay tuned. Welcome back viewers. Now joined by Anesu, our resident investment analyst. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Won't complain. Should only get better yourself.
As always.
Splendid, splendid. Now, take us through the stock market.
All right. Same story as yesterday. Pretty red again on the board. 2% down on the all-share index. Industrials also down almost 2%. That's 1.99% for both of those indices to actually close at 138.83 and industrials at 442.95 points. The mining index was down 1.9%. This time around, it's not Benduro's fault. Rather, it was a real movement that happened there. For that mining index to actually settle at 201.72 points. The top 10 index was down 2.87% for it to settle at 127.41. Now, this movement was pretty much coming from two of the biggest counters on the top 10 on the stock exchange actually, which are your Econet and Delta, that dropped about 8.26% and 5.56% for Econet and Delta to settle at 113.52 cents and 240.01 cents in that respective order. Now, top 10 index had about 5 counters that were in the red, one which was in the green, which is the Old Mutual. Same story as it being a fungible stock. It provides a way out for most investors into the other markets, which are Johannesburg Stock Exchange. Now, as usual, we still find our Padenga still in the green in terms of a year-to-date gain. Now, those losses pretty much extend the 5-day trend to about 6.42% and 6.4% on the industrials and the all-share index in an irrespective order, for the trend to pretty much look like a nosedive on a graphical charts right there. Your miners index is down 5.38% now. Now, just to have a look at our rises and fallers, you've got your Hippo Valley that's added about 20%, while Old Mutual, which is your fungible stock, added about 1.9%, and Axia actually extended on its gains from previous session for it to set at 40.75 cents by adding 0.67% on its prior session share price. Now, Econet, like I mentioned earlier on, now among the 11 laggards of the day that were present on the stock market today, Basimba was amongst them. So was Simbisa. Simbisa used to be in the top 10 index up until Cassava then came into the game, then pushed it out of that top 10 index. Now, Simbisa dropped about 4.29% for it to settle at about 68 cents, while FML, which is the First Mutual Holdings, dropped about 3.85%. Now, Simbisa actually had gained yesterday, but today it retracted from its prior session gains. But for me and the stock exchange, that's about it. But then Forex market, today we had almost a 2% jump on the interbank rate there, coming up to about 2.65 times. This looks like the interbank rate is now chasing what the parallel market is pretty much doing. The parallel market has been pretty much almost stable, sailing around about 3.6 times rates thereabout. So you'll find that the interbank rate seems to be wanting to converge with the parallel market. But as of late, predictions for me as to how that market is going to continue on are a little bit minimal for me, just to have a much better look at how the market is actually playing. But then, if you must know, the ask price on the interbank rate has been jumping pretty much on a very fast rate rather than the bid price. So that's it for me and the markets.
Well, thank you, Anesu. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and visit our website www.equityaccess.net. Thank you and good evening.